I'm joined now by Efosa Aluyi, who is co-managing partner at Astrend Global Investments, to review some of our top stories in more detail. Efosa, good morning. Always a pleasure to have you here.
Thanks for having me.
Right, great. Well, let's begin with OPEC's projection for stronger oil demand in 2026. How might this influence global oil prices, and what's driving it?
Yeah, I think what we're seeing with OPEC is, so if you look back at the last 5 years, the dynamics of the oil markets have been quite interesting. So just going from the demand destruction that we saw right after, the COVID pandemic, what OPEC had done was to sort of go into this mode where it was essentially trying to protect prices. So it had essentially taken production out. In 2023, it sequestered about 2.2 million barrels of crude oil per day. And there were also voluntary cuts by, some members of the OPEC Plus alliance. Saudi Arabia and Russia in particular also voluntarily cut about 1.65 million barrels per day. Now, within that same period, you've seen shale production grow by about 30%, right? So what you are seeing now is that OPEC is also then trying to bring back, this production that it had taken out, into the global market. It started in April of this year. And it came back quicker than the market had expected, actually, because a lot of those cuts were expected to elapse at the end of this year, and some were expected to go into next year. So it started in April by bringing back about 138,000 barrels. In the month of May, June, and July, it brought back about 411,000. And then August, 548K, September, 547K. What OPEC has essentially been doing is trying to bring back production to now try and claw back market share, because what it had done by taking out production was to also reduce its own market share. So I think what OPEC is doing, all of what they are seeing right now, is a play to continue to maintain market share. Now, it expects, global demand to be strong next year. It expects supply to be slightly weaker. However, if you look at what the International Energy Agency is saying, their own projections in terms of demand for next year is about half what OPEC is projecting. If you also look at their supply side, dynamics, they are saying that we are likely to see about an excess of 3 million barrels in terms of supply going into next year. So the IEA is expecting that, the global market will actually be softer next year. OPEC is saying that they expect the global market to be tighter next year. And I think that what OPEC is essentially saying is to align this strategic move of bringing back barrels onto the market with its own projections, right? Because in a market where it expects the market to be tight, it only makes sense that it brings back production. But brings back production. But what I think, is that going into next year, there are going to be a lot of factors that will determine, the dynamics within the oil market. In fact, this year we've seen that at play already. Geopolitical issues, right? We saw the whole spat between Iran and Israel, saw what it did to crude oil prices. We saw the whole trade uncertainty, what it has done to crude oil prices. So all of that is certainly going to continue into next year. The embers are not out. It will continue into next year, and we think that it will have a major impact on crude oil prices going into next year. This year alone, crude oil prices are already down about 17%. So going into next year, not just the demand and the supply dynamics, but I think that the geopolitical issues would be front and center really in determining how weak or strong the crude oil market will be.
Certainly very valid. And this will certainly also, the U.S. is speaking about shale oil production, which you highlighted, because it's expected to see a decline of 100,000 barrels per day. So that's, quite significant. Let's look next is Nigeria raising insurance capital requirements. What should we know about this?
Well, I think it's, part of the plethora of reforms that we're seeing, since this administration came to power. We're seeing the whole banking recapitalization. We're seeing this happen for insurance as well. And I think it's been long in the making, really. So if you look at the capital base as at the end of Q1 this year, if you look at the capital base of the 16 listed insurance companies, it was about 455 billion. Now, for context, that is about half of the capital base of Fidelity Bank. Right? So it tells you that there is a lot of room for the insurance companies to actually grow. If you look at insurance penetration in Nigeria, it's still abysmally below 1% of GDP. If you compare that to SSA average, which is about 1.5%, or you want to compare to South Africa, where it's about 13%, Ghana is over 1%, Namibia is over 7%. So clearly, there is a lot of room for growth within the insurance sector, and a major step towards that would obviously be for them to increase capacity. So what this is doing now is to increase the capital requirement essentially fivefold across board for the life, non-life, composite players, and also the reinsurers as well. And one critical thing that this would do, because if you look at that sector, particularly the non-life sector, the oil and gas contributes about 40% to those premiums and profitability generally. A lot of our insurance companies are really unable to play very heavily there because those are very big ticket transactions. So I think that with this recapitalization move, which they have a year to go through, I think it just significantly increases capacity for the insurance sector. It also significantly increases insurance penetration and will certainly do well, in terms of attaining that $1 trillion economy down the line. So I think this is a very great move. It's certainly going to do well for the insurance sector and for the economy overall.
It's certainly, but very briefly, what is it going to do for market consolidation quite specifically?
Oh, absolutely. So you're likely to see, just like we saw with the banking consolidation back in the day, you are likely to see some consolidation in that sector. The market is, really quite highly fragmented. So you're certainly going to see some consolidation going on within that sector. And a year can seem like a really short time for them to get all of that stuff done. So you're likely going to see a lot of move. And that's why we've seen what we saw over the last week or so in the stock market in terms of, the response in terms of pricing for some of the big insurance players.
Right, so it's a win all around. Well, let's look next. Big story this week, Nigeria approving a $2.6 billion electricity sector refinancing. What should we know, especially around liquidity and infrastructure challenges in Nigeria's power sector?
Yeah, just like you just said, infrastructure has been a major challenge in our power sector. And central to this challenge over the last couple of years has been this debt issue, right? About 27 GenCos are being owed. It's about 4 trillion. If you look at the power value chain, right now we generate somewhere around 13,000 megawatts. Unfortunately, we are only able to evacuate about 40% of that because of the debilitating nature of the infrastructure that we have. Now, that infrastructure had stayed that way because there's not been any incentive to really invest in that sector, right? There's been a lot of talk about cost-reflective tariffs for a very long time. We're beginning to see some moves towards that. We're beginning to see subsidies being removed. The whole idea really is to incentivize investment within that sector. So this approval is really a good one. I think the implementation really now is what we're going to be seeing. The expectation really is that the DMO will take the lead on this. We're likely to see some bond issuance to try and take care of this liability. That will spread the payments over a couple of years and certainly has implications for our local bond markets as well. But I think it's a good move in the right direction. It would certainly create value along that power value chain. It would also incentivize investments because that has been a major challenge within the power sector. So this is a great move, and I think it certainly will bode well for the overall economy.
Sustainability-wise, can we afford it realistically?
So, those are some of the things that we certainly need to talk about. There's been a lot of talk about the power cost-reflective tariffs over a long time, and we're seeing moves towards that direction. And we're seeing all the whole band A and all of that, people getting moved to different bands, and you're even seeing areas where the electricity supply there is really good, so they're having to pay up for it. I think it's going to be a phased approach. It's going to take some time, but the truth of the matter is that there needs to be critical investment in that sector. Right now, you need to make it worth the while of those that are investing in that sector. And I think this is part of the moves because these are invoices that have been, outstanding between 2015 and 2023. So clearing that up, is sort of like creating sort of a fresh slate really for new investments to come in, for people to really look at that sector and see that, it is viable, So that's another critical thing that the government is doing with this move.
All right, so something's got to give just to begin with. Let's look at Asia now with Japan's economic expansion. Now, what's driving this? It's beaten expectations.
Yeah, so I think just to put it squarely, it's really export-led or export-driven. And this is against the backdrop really of a stronger yen. In the second quarter of this year, the yen has actually gained almost 12% against the USD. Now, for an export-led economy, once your currency is, staying strong like that, it doesn't really bode well for you. But against that backdrop, and also against the whole tariff situation, trade uncertainty. Japan only just reached a deal with the US, I think late in July. So again, the full impact or the brunt of those tariffs we really haven't seen. So they will be facing a blanket 15% tariff, particularly on autos as well. Automobiles contribute almost 30% of their exports to the United States. So I think this story is a story of resilience in exports. Exports have added about 0.3% to output for the second quarter against a 0.8% contraction that we saw in the first quarter of this year. So the story around Japan right now in terms of the economic growth that we're seeing is something that is really export-led. However, going into the rest of the year, we think that the impact of tariffs would likely be felt, and we could see a slowdown going into the rest of the year for Japan.
Right, because that would be a great litmus test. The impact is going to be really
Absolutely.
quite the important part. We have just a few minutes left, so let's go with US CPI steady at 2.7%. But PPI's accelerating. What signals does this send about future inflationary pressures?
Yeah, so I think that PPI number just essentially threw a spanner in the wheel, really, for market expectation. I mean, when the CPI number came out on Tuesday, market was already pricing in a rate cut in September, and even pricing in 3 cuts for the remainder of this year. But that PPI number was sort of like a reminder that we're still dealing with, inflationary issues, in the global economy, and particularly in the US economy. And what that PPI number was essentially showing us or revealing to us is that a lot of the producers are not passing the cost to the consumers yet. They are essentially, taking the brunt for now. At some point, they're going to have to pass that. So that PPI number is essentially a pass-through indicator of what you're likely to see in CPI months down the line. So that has then created a situation where the optimism that greeted the CPI number has kind of, reduced. Nevertheless, the market still actually expects that, the Fed is likely to cut in September. However, there is a raft of data that will come out between now and that meeting that will determine what happens with the Fed, really going forward.
Right, that's going to be a huge deciding factor. Well, if you joined us midway, I have been chatting with Efosa Aluyi, with co-managing partner Astron Global Investments. Efosa, great insights as always. Many thanks for joining us in Business Week. We'll see you again
Thanks for having me.
very soon, Miss. Welcome.